Hey everyone, my name is Ivan Delgado, Market Insights commentator at Global Prime Brokerage Firm. Today, I have the opportunity to be talking with Dr. Ernie Chan. Dr. Ernie Chan, he has been involved in the markets, trading financial markets for many years. He holds a PhD in physics. Early in his career, he worked for IBM and then moved on to contribute in the development of automated trading systems for Morgan Stanley and Credit Suisse. He really represents an institution in the space of machine learning and artificial intelligence. He has written several books around algorithm and automated trading systems. So I could just go on and on, but I'd rather stop there. And if Ernie has anything else to expand or elaborate on top of that, take the floor in just 1 minute. But before that, I also want to introduce my co-host for today. He is a Global Prime client. His name is Norm. He runs a business venture that goes by the name TipToeHippo. He revolutionized the e-tail retail market back in around 2010, correct me if I'm wrong, by developing successful automated trading systems for the retail space. Those systems were taken private, and up to this point, they deliver on the results very successfully. He has a passion to actually educate people around automated system, and Norm has taken a lot of inspiration from very bright minds in the space, including Dr. Ernie Chan himself. So before I actually set the ball rolling, and we officially are going to be engaging in these conversations, Norm, let me ask you, how much of an influence Ernie has been for you early in your career for you to get to the point where you are at today?
Well, Ernie was probably the first person with significant knowledge to write about algorithmic trading 10 plus years ago. Mm-hmm. So at the time, we were trying to figure out how to do algorithmic trading, and we were picking up bits and pieces and basically trial and erroring along. And then we came across Ernie's book, and it kind of formalized everything that we'd sort of picked bits and pieces up of, mm-hmm. Structured it all together, explained it all exceptionally well in quite clear language, and basically set us on the path of developing our processes for how to develop algorithmic systems. So effectively, everything that I've got up until now in trading has its genesis with Ernie's original book, which is here. And if you're looking to do algorithmic trading or even systematic trading, I still recommend his first book, which, to do a plug for him, he's just released an updated version of. So mm-hmm. Ernie has been a big inspiration for me, and that's why I'm so delighted to be here today.
Absolutely. I mean, you were a big advocate of having this interview in the first place. And the moment that I wanted to extend the invitation for you to join us today, you were over the moon, of course. So Ernie, let's you're going to be now taking the spotlight, and let me ask you first and foremost, so that we can actually build up a little bit of a foundation and contextual setting on who you really are and what got you interested in trading. Every single trader has a story behind, and I think that it will be very beneficial for everybody to understand what's your background like and what led you to eventually decide trading is the area where you want to be specializing on.
Mm-hmm, mm-hmm. So actually, I had never dreamed of getting into finance when I was in school, and even for the first job that I took after school. As you noted, I had a theoretical physics background, and even though a lot of my contemporaries in graduate school, then in Cornell, were already applying to Wall Street jobs, so it was not unheard of even back in the days to get jobs on Wall Street as a physicist, but I just never got much of an enthusiasm for that for some reason. My passion was machine learning. And so it was very fortunate that I got to do research in one of the foremost machine learning labs in the world at that time, which is IBM TJ Watson. And by a stroke of luck, I ended in a group with some really brilliant people. But something funny happened while I was there, while enjoying my research there, is that one after another of my colleagues started to leave the group and went on to work for a hedge fund that no one had heard of at that time. The name of that fund is Renaissance Technologies. And at that time, few people heard of it. And so I thought, hey, I mean, these guys getting salaries that are 2-3 times what they get at IBM. And I thought, oh, hey, maybe what we did at IBM had some relevance to trading. So I too started to think about, applying it to finance. But I am a city person, so I decided to went down to find a job in Manhattan, which I thought is sort of the center of finance. And I got my first job at Morgan Stanley. And one of the first assignment that we got in a newly formed group called Data Mining and Artificial Intelligence Group was to design trading strategies using machine learning. And it began my 20 plus years of journey in the intersection of machine learning and finance. And I might add, however, that just like many people applying for machine learning to finance, they have found that it is extremely difficult to find a sustainable edge. And so I actually, after working really hard on it for maybe 10 years, I gave up. Not gave up trading, but gave up applying machine learning to trading. And so I decided to quit the institutional investment industry and trade for myself as a retail trader. And as a retail trader, I also suddenly faced with the realization that, hey, let's drop all pretense, let's drop all intellectual arrogance and pride, and get down to the basic. What is the simplest thing that works, right? I mean, if you are, I find that if you are employed by a big institution, the motivation sometimes is quite complex. The driver of your work. You may not solely be interested in generating P&L. You might be interested in advancing on the corporate ladder. You might be interested in impressing the corporate executive. So, there's often a sort of hidden motivation to impress people with your complicated model and your brilliant analysis and your knowledge of the latest and greatest machine learning technique. But profit could sometimes be a second thought. But when you're trading for yourself, all those are irrelevant. It is your trading account, the health of your trading account that is most important. And so fear tend to focus the mind. And it certainly focused my mind to focus on the simplest strategy. And amazingly, it worked. These simple strategies work, as I mentioned in my book, much better than what I've been struggling to achieve in an institutional setting with all kinds of fancy systems. So that was the origin of and I wrote about my experience in the book. That's the reason I wrote about in the book, is that what a contrast between simple things that I wrote about in the book, which often work, versus some of the more complicated things that I have attempted, which didn't work. But since then, in the last few years, there is a new understanding of what machine learning can do to finance. And by the way, that experience is not unique to me. It's not like I have somehow missed some magic that machine learning can bring. And everybody else have been succeeding and I'm just missing the magic. No, if you read some of the experts in the field, they share the same experience. That, in fact, one of the giants in the field, Dr. Marco Sopraxi-Prado, stated publicly that most machine learning hedge funds fail. I feel, after reading that, I feel much better, about myself. I say, my goodness, I'm not the only one.
Yeah.
So, but at the same time, there was a new realization that machine learning can be actually very productively applied to risk management rather than to alpha generation. And, to many people, it is actually, there's certainly there's a relationship between alpha generation and risk management. But to illustrate the difference, I can point one example, which is that let's say you have a trading strategy, and you have an oracle, which is a neural network, let's say, who can tell you exactly tomorrow your strategy is going to lose money. That would be a great oracle, right? Everybody would love that, because even though the system doesn't tell you when to trade, but as long as it can tell you when your strategy is going to lose money, that would be a great thing. And that is what we try to accomplish. And actually, that's quite achievable, not 100% obviously, but much easier than for the oracle to tell you to buy Tesla or short Tesla tomorrow, to buy Google or short Google. That is much harder. But to tell you that your strategy is likely to lose money by learning from your track record, that's something that is achievable. And a lot of people have come to the realization that that is the right approach of using machine learning. So that, in a nutshell, is the beginning of my career to the present time of where I am right now.
Okay, and I think that is very, illustrating that you start by putting forward this case that simplicity works in the markets by applying logic. And I actually want to extend on this. Norm was very kind to put together a type of synopsis on what it comes down to when it comes to trading the markets. And you have been a proponent that even though you have been trading for big investment companies that had enormous, if not unlimited resources, meaning that you could actually get into a very complex development of systems, you came to the realization that at times what really works best is what might be considered or labeled the simplest form of automated trading development. So on that note, Norm had a question to ask you around the ideas that you generate around logic. So Norm, if you want, just take it away. One of the first questions that you had in mind that I know you will be happy to go for it.
Yes. Well, I think Ernie, manual traders could benefit a lot from your knowledge, because you go through a very systematic process of how to create an automated trading system. And I think a lot of manual traders could use lots of those principles in developing their own systems. So talking about logic of your ideas, manual traders sort of tend to think more about it as an art or a feeling when trading. So if you could talk to those type of traders and offer them some advice from the logics and the algorithmic sort of area, what advice would you give those type of traders to improve their overall trading?
Well, I think that one should not underestimate the human mind. First of all, I have a great deal of respect actually for discretionary traders, people who are able to synthesize all kinds of market information and historical trends, technical trends, and fundamental information and news sentiment, and also their own logic, basically apply to all that information and generate a conclusion. And some of them are very successful, and some of them I even invest in. So, despite being a quantitative trader myself, I do invest in quite a few discretionary traders who are extremely successful. So now, that being said, obviously there are discretionary traders strategies that could use improvement and could use discipline. I would say that at the basic level, one has to overcome fear and greed. That it's not rocket science to find that. I think I agree with Warren Buffett when he said that you want to be greedy when people are fearful, and vice versa. And so I think a lot of times for a discretionary trader, the biggest enemy to their trading is themselves. It's not the market, it's themselves. If you can keep your emotion under check to have a disciplined thinking, you can certainly use your own brain and judgment to trade, but you cannot let your emotion cloud that judgment. And I've seen many a discretionary trader that do pretty well in normal times, and when there's a stressful period, they could have lost it all because the lack of experience in controlling their fear had ruined that trading program. Maybe they, for example, engage in some kind of martingale trading. After they lose $1, they try to bet double to make it back. And usually that leads to ruins pretty quickly. And so that's I think, one fundamental attack on a discretionary traders program. Now, there is actually also something that a machine learning program can help even a discretionary trader. So, like I suggested earlier, if you have a consistent style in your discretionary trading program, let's say you are a trend follower, and you oftentimes you have a consistent trend following style, you will find that even as a discretionary trader, oftentimes your strategy will encounter regimes that are unfavorable to a trend following style. And that is something that it can be augmented by a machine learning based risk management system, because even if it is a discretionary trading strategy, if you have a long enough track record, machine learning can learn from it to find out under what circumstance this strategy tend to suffer. So you can still implement, even if your basic signal are discretionary, you can still implement a systematic risk management layer on top of it in order to determine your leverage, in order to determine capital allocation. So I think that that's something that certainly is fairly new advance in machine learning, but it's something that a discretionary trader should consider.
Yeah, and Norm, over time, as you read Ernie's books and you also gather experience through other mentors of yours or other bright minds, have you actually come to the realization that the development of successful automated tradings can be something that through machine learning, data mining, statistical testing, and data manipulation can be made even more robust, aside from all the concepts that you've learned from Ernie?
Well, to be honest, Ernie writes fantastic summaries in his books. Mm-hmm. Maybe not summaries, but outlines. So if you want to an introduction to any of the topics, Ernie is a good place to start because of his writing styles. But I think that the type of people who could really benefit from listening to algorithmic traders are people struggling to find their way initially in entering the markets. So they've just begun trading and they're overwhelmed almost with the amount of advice and systems, and they can look on Google and find a million things that offer astronomical returns for very small prices or a free ebook, and just where to start. And in Ernie's book, and even earlier in this interview, he touched on how he actually found that, I think in your first book, the quote is, if you're diligent and creative enough to try variations of a basic strategy, chances are you'll find one of those variations are profitable. So Ernie was talking about publicly available systems here. So I'd like to throw it back to him and ask him if he had advice to a new trader who doesn't know computer programming, but wants to find a system to work with, what advice he would give based on that kind of quote.
Well, I think that, whatever type of trader you are, you must, have an edge of some sort, right? So if you are, for example, a very a technical person who are, a expert programmer or statistician, definitely your edge would be to go into quantitative trading. But on the other hand, if you're not a very quantitative, person, you might, however, have deep understanding in a particular industry. You might be hey, you might be a pharmacist and you see a lot of people buying a certain type of drugs and they're selling like hotcakes, and you get insight from basically any profession. Most people who go into trading do not come straight out of high school, right? They might have a career as a pharmacist, as an accountant, as a lawyer, whatever profession that they had already some experience in, and they suddenly discover that, hey, maybe trading is an exciting alternative career, but that can build on their insights from an experience that they gained from their original career. So I would say that, as a new trader, not only do you want to certainly read about other people's, trading ideas, of which there are, as you said, Norm, thousands, and you just can never finish reading them all, but to filter them through your own experience and expertise, whether you're from your own profession or your own interest. It could be, if you are interested in sports, you might find that you can filter it through your enthusiasm for sports. If you're interested in entertainment, you can filter it through your interest in the popular culture. There's just so many expertise, so many edge that a person has, through his own experience, that he can apply to filter through these kind of trading strategies. It does not have to be quantitative. So I would say that as a new trader, not only do you want to just absorb other people's experience, but you need to really filter it through your own experience to validate some of the ideas and add your own edge to it in order to be successful. Because otherwise, you are just following everybody else trading, and trading is, as you know, is a very competitive arena. If all you do is to follow exactly what other people are doing, sooner or later that edge will disappear. So that's not that's really not a sustainable way to maintain an edge.
Yeah. And what do you think is the root cause of traders engaging in overly complex systems? Do you think that there is a false belief that the more complex it is, the more that it has to deliver on those results? And how can they actually break through and come to realize, hey, this is a system that just because it is simple in its very nature doesn't mean that it's going to have to underperform another system that is overly complex? When did you actually come to the realization that that was the case, even for your own development of systems? And if I can just hook that up with another second question, is like how your own trading has evolved over time from overly complex to very systematic yet simplistic models of trading based purely on logic?
Mm-hmm. Well, I think the main reason that some traders are gravitate towards complex trading strategy is the intellectual challenge, right? So I think that there are certain intellectual pleasure of being able to feel that you have mastered something complicated, so therefore, one substitute intellectual gratification for financial gain. But that is, intellectual gratification should be a byproduct of trading, not the prime goal of trading. Because if intellectual gratification is your primary motivation, you should actually go to become a researcher in the academia or corporate research, and which is a perfectly noble profession, I should add, but it's not trading. So so I would say that from my own journey is that I think it's critical to put money on the line. Is really a big psychological watershed. You can back test and you can paper trade all day long for years and never invest a cent in, and you would never really be forced to confront the reality that your primary goal is not to lose money and not for intellectual excitement. So I think that to put a significant amount of money on the line, not too much, if you lose that amount of money, it would not be a huge damage to your lifestyle or your family's welfare, but nevertheless, it will hurt. That amount of money would be ideal for a trading account. And with that amount of money, it really focuses the mind, as it did mine, to focus on what really works. Really boil it down to the basic. And you should have, therefore, at that point, no arrogance. You should be really completely humble in front of the market, because we are talking about real money here. And your ego, the market doesn't care about your ego. The market doesn't care about your reputation. All they care is whether you have observed a phenomenon in the market that is persistent and that not everyone has observed. So it really focuses on the mind. It's almost like a meditation. When you have real money on the line, it's like quite meditative, I find. And so that I think is what I recommend some of my traders in my fund, because a lot of these are brilliant people. They come from academic background. They have this PhD and that PhD, and they have brilliant mathematical skills and computational skills. But many of them are finding it difficult to actually create a strategy that generate real profit. And the main obstacle, I fear, is that they don't have their own personal wealth on the line. And that's what really divides a trader from a researcher.
Yeah, I think that's incredibly well put. Now, let me ask you, Norm, is that the process that you follow from very early stages in your development as a trader and building up your profile? Were you slowly putting money in the line and then proving through the real-time live account results that you were getting positive expectation, good, well-adjusted Sharpe ratio, and then you were more confident in adding more on top? What was your process like? And if you could then from there ask a follow-up question to Ernie, that would be great.
Sure. Well, initially, when I started, I thought I was God's gift to training just because I had a degree in economics. I thought, here I come, market, look out. And I promptly blew 2 accounts in probably 6 months. They're only $1,000 accounts, but the first one probably took me days to blow. And then the second one, I probably took about a week to lose $100, and then a week and 2 days to lose the other 900, because you got to chase those profits. So I realized very quickly that you should just, because I come from an econometrics background, trust the numbers. So I couldn't trust myself. So I decided to trust the numbers. And that's why I ended up in an algorithmic trading program. But Ernie is right. We very quickly go from development to paper trading to putting real money on the line. So the TipToeHippo development we just did, we spent a lot of time on our training data and then the robustness tests. And then we use, like Ernie describes in his book, a holdout period that we'll use of a month's worth of development. We'll sit down and we'll go, okay, this is the system that's taken us a month to build. Let's run it on our holdout data once. It gets run, and then maybe 1 out of 3 are successful enough that we like. Then if it's successful, we'll paper trade it, but we only want to paper trade it to make sure that the live results match our test results, so that we can be sure that all the code and it's working as expected. So that might be a month, 6 weeks worth of trading, just enough to get sort of a sample size of trades to match to our back tests. And then in the current example, after 6 weeks, we put 5,000 on. And then after a month, we put another 25,000 on. So we'll probably then double that when we get to 6 months. Because we're in the retail sphere, we think that it's important that if we're saying to people, as we're building up our history, hey, copy our trades, they're going to go, well, do you have any skin in the game? So if we can show them a nice account that's of a decent size, they know that it's for real. And it shows that we've got trust in our process and we believe our process works. And like Ernie said, if you know that you're going to be putting significant amounts of money on your system, you're going to make sure that system works. And the other point that Ernie talked about as well was the goal, he didn't say the goal was to make profit. He said the goal was not to lose money. And I think that's another important one for new traders, because you just think really simple logic that you have 100% of trades and your winners are going to be the ones that you're not losing in. And so if you, when you enter a trade, think about the mini-max idea of minimizing your maximum loss, then everything else is winning. So if you enter and you don't lose, then you win. Or if you enter and you only lose a little bit, then you can enter a lot of times and get your win. From that, the follow-up question to Ernie is, when people are looking to decide when to go live on their accounts, and they're manual traders, how do they know that their system is worth going live in, do you think? Or how could they decide that what they think is going to work will actually work? Because the great problem that manual traders often have is that, unlike us, we can torture data to get results out of, they seem very reluctant to use this trading simulators, which I think they should use. So yeah, how would you advise somebody manually trading to think, well, this system's worth putting 50 grand on?
Well, I mean, certainly paper trading for a period of time is a necessity in that case, because as you said, there's no back test available, and they don't, even if you were to use simulated, well, yeah, actually, a simulated trading environment can certainly accelerate that learning process, because in a paper trading, you have to wait for the passage of time, one day at a time, right, to test your strategy. Whereas if you use the historical data and run it forward like a movie, you can gain the experience very quickly. Day and night, you can run through the market feed as if it is live. So that's certainly I think important before you trade a live account. But even after you gain enough confidence that you are able to trade successfully in a live account, I would advise not to over leverage too fast. I had some painful experience on my own that there was a strategy that I traded for half a year with very little drawdown, and some of these trades in and out in a matter of seconds, and you would earn a profit. And then you would think that you have discovered some kind of a magic bullet and gold mine or something. But after that 6 months come a sudden regime change, and then everything just gone to pieces, and you could get like 35% drawdown all of a sudden, going from practically no losing trade to a 35% drawdown. How's that possible? Well, it is possible in the market because there are things such as regime changes, and a lot of newer traders are not too familiar with this notion that of a regime change. You just because you trade successfully for 6 months doesn't mean that your strategy will always work under all regimes. So I would say keep a certain check on the confidence is always important. You don't want to be too dividend, but at the same time, overconfidence is usually the cause of a big drawdown. And I would say that it's great if your strategy work over 6 month period, but even then, do not over leverage it. Do not increase the leverage too much until your strategy has experienced some change of regime, from, let's say, a quiet to a volatile regime, from a let's say a recessionary regime to an inflationary regime, and so on and so forth. So you will never know as a discretionary trader whether your strategy actually work in all kind of market environment, and you need to experience at least a change of market environment to be sure that your edge is insensitive to that situation, that change in environment.
And a follow-up comment from that, or throw back to you, is oftentimes what I'll see with discretionary traders and people explaining systems is they'll use what I call 20/20 vision, and they'll scroll a graph through and say, oh, the rules fit here. And then here's all the big money that we would have made on this trade. In algorithmic trading, we call that sort of data snooping, where you're getting information ahead of time. And so can you explain to people why it's important that you can't see the future when you're developing your system or you're testing the system, that it's not you basically that, yeah. So can you explain to people why it's important that they can't see the future when making their decisions on whether they are going to take a trade or not?
Yeah, I mean, it on some level, it's obvious that, if you have tomorrow's Wall Street Journal today, everybody will become billionaire overnight. But a lot of times it is very subtle, this influence that, they were not deliberately looking at tomorrow's return, but they were looking at the time series of the past and, kind of trick themselves into thinking that, it's so obvious that, if you buy on dip, that would, rebound and you'll be make a bunch of money. And it is obvious, but they also fail to take into account that there's emotion at work. So, for example, if you look back in 2020, right, and everybody would say that, well, it's so obvious, when the market was down 20%, you should buy. And then, you will recover and make 35, 40, 50, 100%. But the problem is when you are at the moment, you do not really know whether the market is going to rebound. Nobody guarantee you that the market is rebound. And many times you have to remember that at that time, your emotion typically take over, and you would, the instinct is to liquidate and go home. And that usually is the worst time, of course, to liquidate. But you have to take into account, especially for discretionary trader, how your emotional state would be in that situation. So not taking into account your emotion is one form of having what we call in algorithmic trading look-ahead bias or hindsight. So that's one way. And the other thing which I think can help eliminate that is that if one is trading, if one strategy is supposed to be applicable to multiple instruments, whether it's multiple stocks or multiple futures or multiple forex pairs, you should definitely, let's say, is okay to use one of these instruments as a so-called training data, and practice your discretionary strategy on it, whether in as a rerun of the time series or in a simulator or even paper trading. But you should then take that so-called technique or strategy that you've developed and applying it to other instruments that you believe it should work. And that would constitute a out of sample practice. So if let's say you have a strategy in trading Apple very well, and you thought that you have discovered a particular way to trade tech stocks, fine. Well, why should your strategy only work on Apple? Why shouldn't it work on, let's say, Facebook, Google, Amazon, or whatever other tech stock? It should. And so you should apply your discretionary trading by looking at the time series of a different instrument, but without the, but replay it frame by frame without, looking at the end of the movie, right? And see if you can also be successful in trading these other instruments. So it is not hopeless as a manual trader to recreate this notion of training data and test data. You just need to use different instruments for training and then your trial run. And I think that would help improve that technique as well.
Yeah, great. And let's just get some extra insights into how do you know, or how do you determine when a strategy has stopped working or it simply requires some tweaks and some adjustments? Are you able to pinpoint the conditions that lead to decreasing performance in a strategy? I know that Norm has a low correlated balanced portfolio, and that also helps him to minimize the risk when running strategies, because through the combination of all of them, there is not one single that he will be overly reliant upon. So what's your take on that? Where do you draw the line as to, hey, this system is working as expected, it's not working, or it just requires some tweaks? What can you add on that?
Well, I think that here's where certain fundamental knowledge about the market and your strategy would help. So one cannot really, there are people who propose all kinds of statistical tests to tell you, when you are, at this distance from the mean, your strategy is dead. There's all kinds of statistical ideas of doing that. But ultimately, I think that you would need certain fundamental information to make that judgment. So a strategy die oftentimes is due to a fundamental market structural change. And, I read financial magazines just like any other discretionary trader. Not, like I read Bloomberg, I read my FinTrade feeds and so forth, and not because I think that I can directly use that information to make a discretionary trade, right? So a lot of traders would read this Wall Street Journal or Bloomberg and say, oh, hey, they say that certain company is doing great. Let me invest in it. That's not what I try to learn. What I try to learn from is the more sort of fundamental insight into the market structure. So, for example, they would say that a lot of retail traders are now buying call options because of Wall Street bets, because of Robinhood, make it so easy to buy option. Well, that does fundamentally change certain market structure, and that will have positive influence on effect on some strategy and negative influence on other strategies because of this phenomenon. And so you have to make a judgment to see that if you have a drawdown and your strategy is likely affected by this newfound phenomenon in the market, is this phenomenon going to persist? Are these retail traders going to stay forever? Or is it a temporary phenomenon because of the work from home phenomenon and the fact that there's stimulus? And at other times, you also have to read academic research, because there are certain strategies, for example, momentum strategy, that are well known that they have a drawdown in the aftermath of a crisis. There are names given to that phenomenon. It's called momentum crash. And so surprisingly, many momentum traders are not familiar with this notion that there is a phenomenon called momentum crash. And they seem surprised or caught off guard when the strategy had a steep drawdown in the aftermath of a crisis, after it went up so much and become the talk of the town. But it is been that way for last 100 years, since the documented history of Wall Street, that this phenomenon have occurred. So one also need to read a lot of papers, academic research, not with a view towards necessary, again, trading signal, but with a view towards understanding what is affecting your strategy and whether it is normal for your strategy to have a drawdown. So I find that in my own strategy, I can always spin a good story to tell investors why my strategy is not doing well. And if you can even quantify it, but oftentimes it is even if you don't go so far as to use this phenomenon to quantify why your strategy is losing money, but just to have this intuition, will help you decide whether you should stop, based on the judgment whether this market regime is going to persist. And another way that it can help is the adaptation. How do you adapt your strategy because of this new phenomenon? How do you adapt your strategy? If you correctly identify the cause of the drawdown, there's often ways that you can tweak the strategy to adapt to it, and that will revive the strategy.
Yeah. Norm, what's your experience like? Is there room for intuition when deciding that a strategy of yours has stopped working, or do you overly rely on quantifiable data that tells you, hey, this strategy is not worth putting to work?
Effectively, we use historical precedent. So we will go through, and before we put a system live, we'll have its trigger points. So we will say, if it loses this amount of money or suffers a stagnation period of this long, then it is approaching the maximum that we've seen in our historical testing. And so if it approaches that, then we start to look at it and see, is this a problem? And then if it goes past historical precedent drawdown, then likely it's going to get pulled, because we've got so many different strategies that we will pull that one from the portfolio, and then we can create another one that fits in its place. That hopefully, now that there's some more data, we can better create a more robust or a better strategy that fits in its place. So effectively, we base it on history. So even traders, manual traders, I think, can do that if they use, even in a basic sense, some trading simulators. Because the simple fact is, if you flip a coin 100 times, you're nearly guaranteed to get 5 heads and 5 tails in a row in those 100 coins. And humans aren't very good at probability, and especially manual traders who aren't exposed to counterintuitive ideas. So by practicing on historical data, they will see that they can lose 5 trades in a row. That what happens when they lose 5 trades in a row is risking 5% per trade, and then losing 5 trades in a row, and then bouncing up and down for the next 20 trades. Is that what they want? So they can start to get some statistically significant ideas about how their trading system will perform, what kind of consistency and profit it'll bring them, what kind of drawdowns can they expect from losing a number of trades in a row. Do they have lots of little losses followed by some big wins? So they know to prepare for sort of 5 or 6 little losses before they get their kick out of the ballpark win. Basically, if you understand what your system is and you've practiced it and you understand it, then when you're trading it, you can appreciate if it's not performing as you'd expect. And as soon as you see something not doing as what you expected, then you can have a proper sit down and have a look at it.
And whenever you have that sit down and look at it, is that a time when you've essentially switched off and no longer plugging that system into the markets and just kind of give it a bit of a rest and let the dust settle and see what really is under the hood leading to those decreasing performance results? Or do you still run it with lower risk while looking to find out what might be causing that underperformance?
No, it gets sat in the naughty corner.
Right.
So once it's given sort of, once it goes past historical drawdown, it's in the naughty corner, and it said, well, we have to have a look at you. And maybe, for example, it got ran through the COVID crash, and that's why its historical drawdown was bigger than it had ever experienced before. And so it might have a case as to why that's an acceptable thing that occurred. Or it could just be that it's just stagnated for 6 months. And while it hasn't lost a bigger drawdown than expected, you just haven't been making any money. And if there's been low volatility and you're looking at a breakout trader, then you might say, well, that's expected. Whereas if it's been a high volatility market and it's a breakout trader and it hasn't been making money, then clearly there's a problem there and you need to replace it or fix it.
Okay. And Ernie, talking about your trading style and the strategies that you got to develop over time, is it a mixed bag of both mean reverting and momentum-led trading strategies? Is there one that is more dominant than the other? Where do you sit on that front?
Yes, I think that historically I have started off with mean reverting strategy, and for example, one of those strategies that I mentioned earlier, where we barely had a losing trade in 6 months, that was a mean reverting strategy, because that is the type of strategy. Mean reverting strategy is the type of strategy that you can have very consistent return until you suddenly fall off the cliff, right? And it is after we have fell off the cliff that I suddenly recognized that the importance of adding a momentum strategy to our portfolio. And that's when we started to develop this momentum strategy that we call tail ripper. And it is a quasi alpha strategy. And we had found that if we were running this momentum strategy alongside with the mean reverting strategy, we would have little drawdown. We would have been doing great. And so we have been developing this momentum strategy for practically 9 years, and it has its up and down, but it has always maintained its edge whenever there's a crisis. And we find it a good pairing to any strategy, like a mean reverting strategy, even like a long only strategy, where most of the time you're doing great. Just like most of the time, all you need to do is to buy and hold the SPY, and you be beat 90% of the hedge fund. But however, there's 10% of the time, like February and March of 2020, that you will feel a great deal of pain. And that's when the momentum strategy will keep you in sanity intact. And so we have that tendency, therefore, to balance mean reversion and momentum. In other words, balance short volatility and long volatility strategies, so that we would be, generally speaking, generating a moderate return in normal years, because we feel that because we basically are not proprietary traders. We are managing other people's money. So we are providing a particular product. And for many people, they have a lot of investment savings in long only mutual funds, ETFs, whatever, stocks. And they don't need us to provide that kind of return for them. They already long beta. So what our job is to deliver some return, like a high-paying bank account in normal times, but outsized return during a crisis, to offset the tail risk that many people have in their retirement portfolio.
Yeah, and when developing these different trading styles, you would consider, I would say that you should label them as completely different beasts. One, momentum-led strategies, suppose that you will only consider as part of your scenarios big wins, small wins, break-evens, or small losses, whereas the risk-reverting strategies is one where it guarantees a very high win rate, but whenever you do fall off a cliff, it can be very damaging for your equity curve. So I would say that mean reverting strategies is one approach where, as humans, we find it's very comforting because it guarantees a very high win rate. But whenever the proverbial hits the fan and something doesn't work as you would be expecting, that's when things can get ugly. Now, in your case, Norm, have you found that momentum-led strategies is kind of like the sweet spot where you find to be able to maximize the performance of your portfolio and the systems that you develop, or mean reverting is a great blend into it as well?
Well, the current ones that we are doing are a bit different to the long-term one. So the long-term one that we've had success with, it's kind of a combination of both in a way. It's a long-term swing trader, so its positions usually take sometimes two weeks to sort of come to fruition, and can last sort of a month and a half. But what we're looking at is sort of more swing trading in that one, with very short stop losses at support resistance points. and quite long wins, and with a success rate sort of about 2/3, but with profit factors of many multiples. The current one, we take a different approach when we're creating our portfolio. We actually don't look at what type of system it is, just that they're not correlated. And so our idea, because we're using computers to make them, we're saying, well, if one system's a breakout system, and then we want a second system that's not correlated with a breakout system, and we force the machine not to make one, then it's going to make some other system. And so then you might have two systems, and you bring in a third, and you say you don't want the third system, you don't want to be related to the first two. So then as you layer these systems onto each other, they're all trading slightly different things, because you're forcing them, you're making it, when you're machine learning, you're telling the machine, one of its criteria is not to be like the ones that have gone before it. So by doing that, the machine just finds systems that are different to the ones before it. So yeah, that's basically how my thinking has shifted over time. Like when we first started, the algorithms we were writing were kind of directional. So it was like a systematic trader would. There was rules that apply this rule at this situation. And that system has still worked as basically a matrix of oscillators, with some support and resistance and whatnot, and some volatility. But now we just basically are trying to statistically let the machine do it all, and just by the sheer weight of numbers, and then the testing of the systems, which we use a lot of Tim Masters stuff with. We look to the machine via the results sort of basis of figuring out how best to trade. So it's an interesting change in sort of the last 10 years of how lots of the algorithmic trading's working. It's kind of gone from automating systems to almost data mining the systems. But Ernie is far more knowledgeable in all this area than I am. I just sort of piss fart about at home and hopefully make some profits. But so he might have more to say on that.
No, I think that your procedure is actually quite fascinating, right? It reminds me of this mathematical technique of sort of orthogonalizing a factor, right? You are forcing something to be orthogonal to whatever planes that you have already built. So I think that your system is fascinating if it can do that. If you can force it to learn something that is constrained to be new, and it's quite remarkable, I think.
And that's how, when I was talking about before, when we don't like a system, we can pull it out. And so once you pull it out, it creates a hole in the portfolio, basically, that then the machine wants to fill again, because it gets a reward for filling it. So that's effectively why once it gets to an historical drawdown, we can pull it out, because by its nature, it wants to fill it up again. And we can just as well cycle through them. And so we can take one out and then find out, well, is what it wants to replace it with better than what it was there originally? And then we only base that judgment on the training data, because as you know, you can't base that judgment on holdout data, because otherwise you could just be picking the luckiest system. And so you have to have all your statistical robustness tests before you can make that decision, because it's very easy to choose the luckiest system in what we do, when you have to work. The most difficult thing is finding out the best system, not the luckiest system, because when you get all your systems in and you look at them, the best one is likely the most luckiest. And so you don't want the best system, you want the most robust system, because the best system is often the luckiest one.
And Ernie, are you constantly experimenting with new models? And do you believe that continuously having a period of stress testing new ideas is something that will be beneficial for potential introduction of new systems into the portfolio should the previous ones stop working? So are you always engaging in these ever evolving conditions in the market, and therefore you want to be there experimenting on new systems?
Yes. So, over the years, we have evolved our sort of portfolio of strategies in two ways. One way is that we actually are going to allocate to traders who already have a successful track record, and not just historically, but after we engage them, they still continue to demonstrate an edge. So for these traders, we find that it is sort of a meta strategy, right? So instead of directly creating a strategy to trade in the market, we have a meta strategy to screen who are going to create these strategies, and we find quite some success in that. We had so far 7 sub-advisors and traders that trade for us, and all of them have been profitable since inception. It's better than our own strategy. I couldn't say that when I launched 7 strategies, all 7 end up profitable. Far from it. But the meta strategy was able to accomplish that, which is to our surprise. Now, our own research, we of course still engage in our own research that you might call it in-house research, but for that we mostly focus on, as I highlighted, machine learning based risk management, because we find that our edge, my personal edge at this stage, is not only to pick traders, but also to provide proper risk management to these traders through machine learning. And that is really, that's going back to my roots, to my first love, really, as a machine learner. And so that's how we've been operating. Whereas before, we pulling our hair out and trying to create new strategy ourselves with my team of researchers, because of our small size, it's actually been quite a bit of an uphill battle. But with this method strategy, we are able to scale and diversify much more quickly. And with our risk management system, we are able to also devote more time to what really differentiates us.
Mm-hmm. And you've been quoted as saying that the systems that work for you are conceptually simple, something that we've touched on a number of times today. Now, when I'm thinking about the markets and the application of some indicators, there needs to always be a purpose behind why you're using that indicator. Otherwise, you can be completely inundated with a plethora of indicators that are going to be serving no purpose. So you could be thinking about market structure, momentum, support and resistance lines. You could be thinking about volume, volatility of the market. Are we in a high or low volatility environment? So to me, those would be like the cornerstones, right? The main pillars that can help you to determine the development of a strategy. In your throughout the years, are there any indicators or any market truths, such as reading market structure, momentum, etc., that have become most dominant for you to develop trading systems? Or there is no such thing as one indicator or a suite of indicators being most dominant as part of your strategies?
Yeah, I'm not, I'm of the view that there are multiple different indicators, instrument to observe the same reality. There is no unique one that you have to use, otherwise it won't work. They capture different aspects of the reality. And that actually also jive with the machine learning approach, because in the machine learning approach, you are trying to have as many input as possible. The more indicators, the merrier. We do not discriminate. The more the merrier, the more diversified the merrier, and the machine will screen them properly to decide which indicators are the most successful. But in the beginning, we let we welcome all comers, really.
And when you crunch that data, are there any standouts, any standout indicators that come ahead?
I wouldn't think so. I mean, a lot of times, a lot of indicators have high correlation with each other. And so some of them perform better in this environment, some in another. And so a weighted approach usually works best. You want to include all of them with some weight on each.
Yeah. Norm, do you have any other question that you would like to touch on?
No. I think it's been quite an interesting chat with Ernie, and I'm delighted to have gotten the opportunity to chat with him today.
Yeah, likewise. It's been a fascinating talk. Ernie, do you have any parting word? I would actually like to, if you could just share very briefly what's about Predictnow.ai. There's I believe this is a new website that you've launched and you're collaborating. What is it that you do on that front, Predictnow.ai, if I may ask?
Well, it does exactly what I was talking about, which is risk management based on machine learning, right? So as I said, if an oracle can tell you exactly when your strategy is going to lose money, your strategy will become the best strategy in the world, no matter how little money you make when you win. As long as you never lose money, that'd be great. And that's what we are trying to offer to traders, because, and people say, well, if you have a website that tells you whether Tesla is going to go up or down tomorrow, it cannot be scalable, that website, because as soon as you have 100 people subscribe to it and everybody trading Tesla using the same signal, the signal will go away. But that is not the case for risk management, because this website actually learn from each trader's own strategy. The input is not the market signal. It is the return of your own strategy. And we are trying to learn our own strategy augmented with big data. We now have over 600 input fields to augment this returns track record to give you a probability of loss of your strategy on every future period, so that you can decide whether to take that trade or how much leverage to use for that trade. That's the service that we offer to traders. And we have been doing that for just over a year.
What about if clients of Global Prime or anyone interested in your work wants to contact you? Do you have any blogs? Are you active on Twitter? Where can people contact you?
Oh, yes, I can be reached through my Twitter feed. Certainly, Chan EP is my Twitter feed name. I'm
going to be adding the link in the description box.
Yeah, and also LinkedIn. I accept all connections, and it's linkedin.com/in/EP Chan, not Chan EP this time. The tree is taken, Chan EP, so EP Chan. And of course, on my blog, I always reply to comments. My blog is epchan.blogspot.com. So that's my blog. Yeah.
Okay. So from my side, my parting words would be that I believe that when we trade the markets, it's really, let's face it, it's a rather solitary endeavor, and one that sooner or later we want to connect, we want to engage with other people. I believe that over the years, you're leaving behind a great legacy, one that in today's conversation, by talking to Norm, it is proof of that, because you have been instrumental, you have been influential on his development as a trader, as I think, and that can actually only be multiplied by 100-fold, I believe, so many that have been impacted by your work. So I thank you very much for taking the opportunity to join us today. Norm, if there's anything that you want to say, take the floor. And with that, we will conclude today's conversation.
I think what we can take away from what Ernie's advice to new discretionary traders is to simple works. Don't just overcomplicate it for the sake of overcomplicating things. Check your risk. Make sure that you're not risking too much. Practice. So get your trading simulators and practice as much as you can, because then you'll get an idea of what your system does and what its drawdown can be. And then from that, once you've practiced and you know what your system can do and it's profitable and you understand the drawdowns, shove some money on it and become a proper trader.
Yeah, and have passion and realize that this is a tough business, and it's not for those that want to actually grab money in the short run. Otherwise, if passion is absent, I believe that sooner or later you will increase dramatically the chances of giving up at some point when the results are not in your favor. So that passion needs to be the underpinning factor that is going to keep you going forward, experimenting, falling better. And with people like Ernie around us, that certainly makes our journey easier. So for that, we thank you, Ernie.
Thank you for your kind invitation, and thank you, Norm. Excellent, great questions.
Yes,
thank you
fascinating.
for your.
Thank you, gentlemen, and for those that join us today, thanks for tuning in. Like, subscribe, make comments, and we'll be happy to respond. Thanks.